Basant Maheshwari is with me now on the show. He's investor and author of The Thoughtful Investor. And he's a thoughtful investor as well. He's got a big fan following, social media and otherwise. And people watch him for advice on the market. And they also watch him to understand his philosophy on how to think about the markets and actually pick stocks. Thanks very much, Basant, for making it to our studios here in Mumbai. Thank you very much. Let me start with a obligatory question on the market. So what's your view, Basant? What's going on?
Thanks, Prashant, for having me. The last time we met, I told you that the bull is sleeping, but it isn't dead. I guess the bull is sleeping and it's even snoring right now.
Maybe the bull is drugged.
I don't know. Some bulls like me are surely drugged, but the point is, trying to assume that a stock would go up without earnings is like trying to drive a car without petrol. So there is no fundamental backup in the basic structure of the market. If you see most of the stocks like the L&Ts and whatever. I mean, every quarter we go to them and we say next quarter would be good. 2 quarters down the line would be good. Basically, it's like, telling the groom who doesn't want to get married ki chalo shaadi kar lo, and we, the sell side analysts and the investors are the baratis here. So the groom doesn't want to get married, the company doesn't want to commit, but when you force them so much, they'll say, okay, maybe next year should be good. But I think the overall market looks tough. It wouldn't go down too much because we've already seen corrections, and it wouldn't go up. So it's a typical analyst explanation of being range bound, but I think within this space, there are companies which are growing at 25-30%. I think the effort should be to look at those companies, the smaller sized companies basically. Because the trick of the market is if you buy small caps during a bearish phase, it's better than buying the small caps during a bullish phase, because small caps give you outsized returns when markets turn, and we assume that if the company is well thought out and bought well, so it should do well.
Investing is a constant process. On television, when people come on and sort of start talking about markets, it's almost as if, well, they came into the market that day. I mean, you are an investor, you are in the market, a bullish phase or a bearish phase. So I think that context is important. When you say that buying small caps in a bearish phase is better. So you already bought them. You already own a lot of the small caps that we are going to discuss, right? You're already in the market. And it's not as a small, would you still say small caps are in a bearish market now?
Over the last 4 to 6 months, my personal portfolio has seen a very big shift. So a sector which I never used to own, called the pharma. So these days you could say I've become a drug addict. So, it's mostly pharma because that's where you see consistency, that's where you see predictability, that's where you see surety. There are small caps, mid caps there. So we just spread ourselves there. And I think the focus remains to look at that, because 2 things would happen. First is the Fed would increase rates and the Indian government would, the RBI would decrease rates over the next 3 to 6 months. So both of them are dollar bullish. So that's the big macro tailwind. And the off-patent drug going and then the generic market opening up and those kind of things, obviously everybody knows about them. And the point is, if you can't find companies that are growing at 25-30% in the basic economy, you go and search for some stocks, and that's how we found them.
I could also interpret what you said, that personal portfolios undergone a big change and you become a drug addict, not literally, but pharma is a large percent of the portfolio. To say that you're disappointed with the rest of the market. I mean, you said that you were finding consistency here, which means that on other parts of the market, you're not finding that consistency. 2
parts to it. The part of the market where you find consistency, the consistency isn't too much to attract you. And there's another section of the market which is cheap, which is beaten down. And there you're betting on hope. So, markets pay for growth while speculators bet on hope. So I think trying to buy a small cap goods company. See, one thing I'll tell you is, let's take a company like Thermax. It's not an example. It's not a advice actually. It's just an example to illustrate the point. Thermax will see an uptick once there is a decline, once there is an increase in the existing capacity utilization, right? So first the existing capacities have to be utilized, then people go and book for new capacities, and then companies like cap goods in the cap goods space would do well. So that's still some distance away. It's not that it's not going to happen. It's going to happen 3 to 6 months, 9 months. But then, if you can find something that's doing well right now, so why not back that up instead of trying to, throw a dart in there and assume to hit the bullseye?
But in a way, you said that over the last 6 months, so the change happened in the last 6 months or so, right?
You're catching me well. Yeah, the change has happened.
Right. So what changed? What prompted you to make that change? You said, well, okay, this will stop working, and now this. Oh, so what triggered that?
As an investor, normally I don't have the habit of saying ki, if the stock doesn't do well for 1 year or 1.5 years, let me stay with it, because investment is always a relative opportunity game. So if I got two companies, one growing at 20%, the other growing at 20%, and one of them is priced higher and the other one is priced lower, and the consistency aspect is similar in both of them, then you make a switch. It's not that making that switch looks bad or whatever, but the point is, money is always finite, whether you have $1 million, $100,000, 100 million, or 10 billion, whatever. And the opportunity that money can be put in is multiple. So, you look at the best alternative choice for your money and then you put it there. So that is how it is. And in the pharma space, I've seen there are small caps and mid caps as well.
No, I just want to press on that point. So, let's just put these graphics up. These are stocks which we've discussed in the past with Basant and what he owns. So, Page, for example, was a big bet, and actually, Basant, you became synonymous with Page Industries. I can say that. I mean, when people had to expound a theory, bullish theory on Page, they do the whole business thing, and they're also kind of slip in the fact that you own a lot of Page Industries. So, just a quick disclosure: you still own Page? Or not?
I'll just pass that through because it isn't appropriate for me. See, we've been approved by SEBI for a PMS license, so it isn't appropriate for me to go into specific stocks. But broadly, I might own a bit of these or I might not, but broadly there is a big shift that has happened. So I would just...
Okay, you can't talk about stocks, but I can.
I obviously
I can. So I think what Basant indirectly is saying is that he's if not completely, he's out of Page mostly, right? I mean, a stock which has made a lot of money for Basant over the years.
I just agree with the last part of your statement. It's made a lot of money for me over the years, and the other part is conjecture. I just wouldn't like to comment.
I think he is mostly out of Page, because if he was not, he'd come back and correct me. Anyway, the other names, Hawkins Cookers, Pantaloon, Titan, I mean, Grew Finance. What percentage of the portfolio now is pharma? I think let's get that number.
It's significant, and as I told you,
your personal portfolio.
It's really significant. It's significant. As a personal investor, you can put 40-50% of your portfolio into a sector. It doesn't matter to you. But if you're managing funds, if you're doing a mutual fund, then you have those restrictions. If you're doing an AIF,
so more than 50%. Again, indirect.
I haven't calculated, but it's significant.
Okay, more than over 50% portfolio in pharma, essentially, at this point in time. So that's a big shift. I want to come back to the reason why you made the shift. Did you? So it kind of goes back to the basic question: how do you decide when to sell, right? So A, the thesis can change. B, you think you've already made a lot of money and it would be unreasonable to keep wanting more. Which one was it? You thought, in a lot of these cases like Page,
none of these two. I'll explain why I'm saying that. First is, if you think you made a lot of money, that's not how things work normally. You have to look, personally, I always look at the next best alternative and whether the opportunity that I'm getting is better than the one which I own, right? So, and the thesis hasn't changed. I mean, the entire thesis remains the same as it was 2 years back. The entire culture, the consumption boom, the HFC boom, that doesn't change in 1 or 2 years. But as investors, we always want to, make the money count, make the money talk. So,
but we are not talking about, you're not buying some thing called the urban consumption boom. We're talking about Page Industries. For example, I'm giving you an example. And the reason you would decide to sell that is if you thought it's already done quite a bit, it's made a lot of money for you, valuations are too high, and then you think, well, the risk reward doesn't sit well, and there are more attractive, relatively cheaper securities which can make you a lot more money, right?
No, let me come back to you without being specific on Page. Let's forget Page. Let's say I own Acer Motor, right? Let's say I own Bosch or MRF or whatever. You continue to own it if you think they will do well in the future. But if you get another alternative, then you shift a little here and shift a little there. That's how things work. But I'm not making any statement on a specific company because of the restrictions that we have. But in general, I think...
Come on, Basant. The restrictions, you will have plenty of restrictions to comply with once you get the registration done. So make the best use of the time before that.
Let's talk about pharma.
Okay, all right, fair enough. Okay, let's talk about pharma. Over 50% of the portfolio in pharma. What did you see there? And you specified, you said that most of the stocks in pharma are in small caps.
No, not the
mid
percentage.
caps.
I haven't calculated, so I'll have to come back to you maybe in the next interview how what percentage that is.
Okay.
But see,
you aren't giving me anything here.
No, no. Actually, let me just explain to you.
Okay, fine.
See, in this present scenario, with drugs going off patent, the old theory applies. Last time we discussed a couple of pharma stocks, the large caps and the mid caps as well. I think that's the only sector right now, not the big ones, not the sun and the moon. They're already in their own things. We see a 2 lakh crore market cap company cannot become a 5 lakh crore market cap company very easily. But if you're getting a 500 crore market cap, 700 crore market cap, 300 crore market cap company with FDA regulations in place and which is supplying to US, so I think and the opportunity is huge in this space. So and in the best part in pharma is every company is unique in its own way. Like what on your screen I can see Torrent and Cadila. So what Torrent does, Cadila doesn't do or cannot do, and what Cadila does, Torrent cannot do. What Sun does, Lupin cannot do, and what Lupin does, Natco cannot do. So in their own ways, pharma is different from IT in the sense that there is a certain degree of entry barrier.
Really true. I mean, a lot of them are. A lot of them do contract manufacturing. A lot of them make APIs. A lot of them do, and a lot of them actually do the same thing. I mean, a lot of them. 3 or 4 Indian generic pharma companies make the same drug. I mean, they compete for the same products.
No, broadly they do.
They file for the same drugs applications with the FDA.
No, broadly they can do, but they don't do. I'll give you an example. Like there's a drug called Abilify which came in the US earlier this year. So I think from India just 2 companies are doing it. One is I think Torrent and the other is Alembic. Both of them are good enough. No recommendation, just we are discussing what happens. So every company finds a niche in itself and then it starts to work on that. Like CRAMS is another space. So there also you've got multiple options. You've got a Syngene where it's like an IT offshoring model where you put more people on the job and then you get a 25% CAGR over 2, 3, 4, 5 years continuous. So it is not that we come to a sector just because we find we like that sector too much or we fall in love with that sector, but because the other alternatives don't give you that kind of a sense that what if I were to buy. See, let me tell you, if there is an industrial recovery, the big money will be made in the second tier and the third tier cap good stocks. But trying to forecast that recovery is very difficult. How would you know when that would happen and when that would? And one thing, industries normally expand when the return on capital exceeds the cost of capital. So even if the cost of capital were to come down, I mean it should have come down a lot earlier, who will guarantee these guys that the return on capital will always come to you? Because the existing capacities have to be utilized first. So there are various things here, but again the question of where you want to bet. Do you want to bet on certainty or you want to bet assuming that things would happen? But that is how it is. It's really tough in this market to find one secular theme and back it up.
But you seem to have found that one secular theme in a way.
At least I hope that I have.
Yeah.
So only time will bear us out in this. But I think...
okay, I'm not asking for recommendations here, but give us a few names which you think are worth studying for that investors should go back, look deeply, look at annual reports and do homework.
I think the second tier pharma companies, the HFs, I think one sector which I still think any investor could just buy is buy all the housing finance companies and then go to sleep. So you got 6, 7 of them, buy all of them. So and just go to sleep and do nothing for the next 10 years. He's going to generate between 18 to 20% CAGR over the next 5, 7, 10 years. So even if one of them goes bust, it doesn't matter to him. So that's a very simple style of investing. But the other way is like, I'll have to.
From that comment, I infer that you own all of the Group Finance that you own, right?
I'm bullish on HFC.
Okay, all right, fair enough. So come back to the pharma point. Right. I'm asking, stating clearly, should not be construed as recommendations, but what are the names that one should study? I mean, you bought these stocks, right? Or are you still buying them? So you don't.
No, I will talk about 2 stocks which I don't own because it's easier for me to explain them. One is Torrent and the other is Cadila.
Okay.
I don't own them.
Okay.
And why they are good is Torrent has got a 10-year history of doing a 25-26% CAGR top line. And Cadila is also run very well. One problem you will find in these companies is they supply to Brazil. And the Brazil economy has gone for a toss and their currency has gone the other way around. But that's what's going to happen. You can't assume to have these companies have a one-way traffic. But these are two large cap companies. By the way, Torrent's annual report of last year is a very good read for somebody who wants to understand pharma. So you go and pick up 2014 annual report of Torrent. It gives you a very good sense of what the pharma thing is. And if you want to understand pharma, it's very difficult. What you do is you go and read one of these large companies, the annual reports, and like Cipla's annual report says, I think this year or last year, that the sector has grown at 16, 17, 18% CAGR since 1980. So assume a sector which grows at 18%. Oh no, you can always turn back on me and say, what was I doing all this while? But that's okay, yaar. I made my money elsewhere. So, jab jago tab savera. That's one what we say in Hindi. So that's how it is. I think Cipla is more for the guys who wants a stable income, 15-18% thereabouts. Torrent and Cadila, little aggressive. Not the real mega caps, the large cap. Still doing well. No recommendations, just go and read their annual reports. You'll get a very good sense of where these companies are going. And look at the history. Last 10 years, 15 years, they've been growing at 25-30% CAGR, top line, bottom line. So that is how it is.
Just on that point that you said, the annual report of Cipla, I think you said the sector's grown very, 16-17% for the last 2 decades, more than 2 decades. But that's in value terms, right? The size of the market has grown. That's what they're talking about. I'm sure volume growth has not been that large. It can't be.
No, but market price is determined by value, no? It isn't determined by volume.
So that's what I'm coming to. Now, recently, last 1.5 years, there is a lot of focus on pricing. There was this one drug company which was in focus, right? I mean, that I think curing pharma.
They went up.
And then there was one more, which I think the company that Bill Ackman owns, Valiant, right? So there was a fair bit of focus on that.
Right.
And all of that is in a way related to pricing, disproportionate price increases, and the regulators looking at it. It gets more attention because there is an election on in the US, etc. But is that a risk now? I mean, do you foresee any risk?
There are two segments to it. What you are suggesting is absolutely correct, but that's for the innovators. The companies that we have in India, we don't have innovators in India. We just have copiers in India, the process patents, and you take a drug and then you reverse engineer it and how you want to do it. So this strategy of increasing prices of the final drug, that's for the innovators. In India, we don't have innovators. I doubt if there's even one innovator in India. I mean, of course, there are companies who are trying to push their molecule through, but that's one of those.
But the point is, if the innovator is charging 10 rupees a capsule, the generic company is charging a rupee. If the innovator gets to charge only 5 rupees, the innovator will charge 25 paisa.
So the thing is that even if the innovator charges 10 or 20, he's not going to give you more than what you're going to get in any case. It's not that if he charges 20, he's going to give you a little more. So everybody's got their commercials arranged.
What about the other issue? And I've heard this, and this was the FDA bit. I mean, yesterday I spoke to Nectar Life Sciences, right? And they're awaiting a plant approval, the Baddi plant approval. There's a formulations plant.
Let me give you an example on this. Again, not a recommendation at all.
No, let me complete the point for viewers. What they said, and others have said this as well, that the FDA has consciously increased surveillance. They've got more staff to inspect plants and generally a more robust system. So companies have to basically match that, and they can match that. Your thoughts on this?
Suppose there's a company in India which is doing a B2B business, right? And you're supplying to Mylan. And the FDA comes tomorrow and it shuts your plant down. So you are a 1,000, 2,000, 3,000, 4,000 crore market cap company, but Mylan, which has got billions of dollars on stake, wouldn't like to have its plant shut down. So what happens is, if you look at the B2B space, right? So in the B2B space, what happens is, if you're supplying to Mylan ensures that its people come and visit your plant once a month, twice a month, and ensures that in case of an FDA inspection, nothing goes wrong, right? So in the B2B space, the stringency is more when compared to the B2C space. In the B2C space, we had this Vocard incident. We keep having this Sun Pharma incident off and on. So that is, but I think in the B2B space, more than the FDA, your counterpart in the US who is buying from you normally wants to ensure that your things are in place. So in the B2B space, there are options, and I own both in the B2B. I own a few of the B2B companies here. I can't take names, obviously. So one of them is disclosed earlier also, and that's how it is. One example I can give you, which I don't own, just for example, what a B2B means. You could look at Strides, for example. They are something like a B2B types. So, that way.
I think the name you're referring to is Granules, right? You can't talk about it, but you'll get a denial from you if that name was not true. Anyway, are there companies which exclusively do it? So then we're basically talking about contract manufacturing type companies, right?
Somewhat like that.
Yeah.
See, one thing you'll find in pharma, you won't get a 40% ROE company here.
Yeah.
You won't get a 50% ROE company. But the scale of opportunity is humongous. And once you develop your skill sets...
larger Sun, Cipla, Dr. Reddy's, I think the ROEs are pretty strong, 25.
No, they're not B2B, na?
Not. I'm just saying that there are those companies. And that's why they've grown so big, right? I mean, in terms of market value, etc. There are those very high ROE companies. But that's not what you're focusing on. You're focusing on B2B companies, where obviously, since you're selling to a business, the profit margins, etc., will be much lower.
And Prashant, let me explain one thing about. Suppose there's a drug which goes off patent next year. So when a drug goes off patent, we all know that the price falls 90%. When price falls 90%, the volumes go up multiple times. So if you're the API supplier to that drug, right? So your business will grow up 5, 7, 10 times as much as the volume increase. In any case, you won't make more money now, and you were not making more money then, because the guy who sells at $40 or the guy who sells at $4, he knows how to keep his commercials in check, right? So if you're looking at API suppliers to companies whose drugs are going off patent, then it gives you a certain sense that business can grow at 25, 30, 35% as well. So, or you've got some, so this is how you figure it out. But pharma is like an ocean. I mean, you can do anything, and still, it's like, there's no one set pattern of how you invest here. Things keep changing, and that is how it is.
You sure you can't focus on a few names?
I wish I could.
Just for example, just to
I've
shine the spotlight.
No, I've taken names, but I wish I could have. I mean, the regulations bind us so much, and that's it. You know it as much as I do.
So, I mean,
off the camera, I've told you whatever.
Yeah, for our viewers, Basant is getting into managing public money as well. He's waiting. I think you said earlier that you're waiting SEBI approval to launch a PMS, right?
Yeah.
That's a portfolio management service, and in the process of kind of getting all of that through. Okay, fair enough. So, will that also reflect the portfolio, the personal portfolio construct, or you'll be a little more constrained there? Which is to say that pharma, heavy pharma.
Obviously, you cannot deal with, these are things that keep changing, and everybody has got his own risk appetite. You cannot paint the entire thing with the same brush. So it depends on the kind of person whom you're dealing with, and then you take it that way.
Yeah. Are you just one thing? Is the conviction very high, like there was in Page, etc., when you held them for many years?
At least for a couple of these companies.
The B2B smaller pharma companies.
I'm super bullish.
Super bullish.
Yeah.
Okay. All right. Just one last question, Basant, on the broader market and what's happening. How do you foresee? You said that when the industrial recovery finally happens and the smaller companies will do very well, but the point is that will happen, and then the existing capacity will has to be used up, and capacity utilization across sectors is very low. What is going on in your assessment? Is the thesis broadly okay? Is it taking more time, or something has gone wrong somewhere?
Whenever we met earlier, I've told you, 2 successive bull markets are never led by the same sector. So IT in 2000, cement in 92, infra real estate in 2008, retailing in 2008. So 2008 to 13, 14, it was something else. So I think the bet, if at all, if you're trying to bet on the infra companies and the beaten down names, I think the bet should be only on a bounce and not on a trend. But if you're trying to bet on a trend, the first thing you have to see is the stock will tell you it's going higher. And how does it happen? A small cap will first hit an all-time high, and that's not the time where you have to go back. If a small cap that you like and is backed by fundamentals, and if it hits an all-time high, pick out your phone, call your broker, and dig deeper into the stock. So I think that's the way to look at it. But if you want to buy just for a bounce, the infra names, the PSU banks, the beaten down names, they're going to give you a terrific bounce. But nobody's played that bounce well. I mean, everybody's missed the catch, so...
More fleeting. I mean...
yeah, it's very difficult. It's very difficult to actually buy a stock 30% down and sell it 60% up, and then, retain that money for 3 years. You're going to blow it up somewhere. So that's not the trend which I normally look for. So basically, you have to be assured from the company's side also that things are well, and that you'll get in the results.
Basant, thank you very much. Great speaking with you. It's a more guarded Basant Maheshwari today, this morning. I hope to
agree.
chat with you again soon. Thanks indeed, and good luck with the PMS venture.
Thank you so
Appreciate it.